Sanjay Parekh, founder and CEO of Sohum Asset Managers. So thanks for joining in. We've had a bit of an intermittent rally the last 4 or 5 days, and that's a bit of a relief after the drag over the preceding couple of weeks. Yesterday was probably the first day of some serious FI buying as well. How do you see the telltale signs? Are you constructive from the current levels? Are you sitting more cash than usual or less? Are you more large caps than usual or less? Tell us a bit about it.
Yeah, so Neeraj, good morning. Tamanna, good morning. So essentially, we have an earnings season which is going to be weak. This is for Nifty, as we see, earnings could be like 7-8% growth for earnings. And then, of course, we had Q1 also weak. Last year also, third and fourth quarter were weak. Going ahead, very likely, and we also strongly believe that we are nearing the bottom of the earnings growth cycle. So Q3 onwards, we will see benefits of, the GST advantage. The base effect will kick in, and of course the earlier advantage of, the income tax benefits. Also, the overall, in terms of the RBI, which has reduced the interest rates, will also give fill up on demand. So we believe that Q3 onwards, things should look better and Q4 certainly should be good. Having said that, this will be a year of low earnings growth. Let's say broadly, it should be 1100 this year. Then by Jan, Feb, March, markets will look at 26, 27, 27, 28. Broadly, the earnings are 1300 for next year on a low base, and then 1450 for 27, 28. So if from there, take an 18-month view, and we take India at 20 times, we're talking of 29,000 over 16 to 18 months. So we believe that, we are looking towards 16 to 18% return in 16 to 18 months with some risk of time correction and price correction. And this has been our stand, and broadly it has worked.
Sanjay, a very good morning to you, and good idea not to get out of your office and venture into BKC this morning, as all of that traffic builds up more than anything else. I'm just wondering if you're feeling positive about IT right now. Of course, the big numbers start rolling on tomorrow morning. There has been so much negative news coming in, India-US relations, H1B, AI, etc., etc. What is this silver lining that the market is seeing, and are you seeing that silver lining as well?
So we have been underweight for 3 years now, and today also we are underweight, and we believe there are definitely a lot of headwinds. Before all these issues around H1B, also the earnings growth was expected at 6-7% best case. Now we're seeing that more than the H1B, which is on incremental visas, clearly directionally there can be headwinds from the US administration, and we can't ignore that. So there can be further measures, there could be some cost pressures, some contracting costs that can go up, and AI clearly is a threat. So AI is one where we think that more than the cost advantage, the contraction in revenues in certain segments will be there. So we believe that, we will remain underweight. We continue to look at select stocks who are well poised in the AI space. But overall, I think, growth will be muted. So we think that there can be rallies in the interim, which we have seen earlier also. But we don't see any structurally growth coming back.
When you say rallies in the interim, where is that focused? I mean, the consensus topic seems to be emphasis at the end of the day. Is that in the direction that you're heading in as well, or will you continue to be largely underweight?
So the underweight has worked for us, but we do keep an eye that Nifty is a benchmark, so we couldn't have been zero. So in terms of stock selection, we used to own Coforge and Persistence. Right now, we don't own it. At a price, they are well poised, but not at the current price. So we have Infosys for now, and overall, we have underweight stand, which we are okay to. I mean, as I said, it's broadly worked over 3 years. In the interim, it has given some pain, which is fine. But we really feel that structurally growth is going to be muted, given the headwinds in the sector.
Wow. Okay. Sanjay, so if you are, what, 70, 72 odd percent large caps, and that is the
Yes.
safety of your portfolio, where is it that you're playing for alpha? I'm guessing that's the broader end of the spectrum. What within that bucket?
Yeah, so Neeraj, see, we have done some analysis that even in larger caps, the divergence in returns are very, very high. So last 1 year on September, the returns of Nifty is -5% on 1 year. But the top 10 average has done 25% plus. The bottom done 10 has done -22%. And I'm talking of not one stock, 10 average of the top 10, below 10. And same on 3 and 5 years. So we strongly believe that we would always have Nifty companies more like 15 to 20 names. We would avoid 30 names. So we believe that to get the right stock selection, even within Nifty, and to get that alpha from large cap is our first major objective. Middle small cap, we would what we call as we play a loose ball. That we're not in under any pressure to buy at any price. We would look for those weak value stocks in middle small cap. Ideally, they should double in 3 to 4 years. And if we get those, we would have a measured bet, which is more like 2 to 3%. We have an upper cap of 3% in middle small cap to manage the risk. So that's our strategy. Our GARP style has worked us. Our price earning of the portfolio is 13.5 times on 27 versus 18, 19 times for Nifty. Our ROE is higher, our growth is higher. So it's worked for us in terms of performance also, and we will continue with this style.
The other interesting part is that if you just look at the point of where some of the large caps have also given returns, but the valuations might be comforting. Oil marketing companies, Sanjay, for example, I mean, a 3-year, 5-year, 10-year CAGR number versus a Nifty total return index would show that they've actually given very good returns as well. I believe the last time that we spoke that you were constructive this bucket. Are you still constructive? Because oil seems to be structurally on a downtrend.
Yeah, I mean, so, we did some work and I sent you that as well, perception versus reality. So on 5 year, 10 year, 15 year, 20 year, HPCL and BPCL have outperformed Nifty and Nifty by a mile, Nifty TRI. So on a 20-year basis, Nifty TRI has done 1100%. HPCL, BPCL have done 1900%, including dividends. So with all the uncertainty, these are the returns. Now, the other major event was, of course, there are government interventions, which was a concern, which is a valid concern. But recent visit of the oil minister and the secretary oil and gas, they clearly explained that how they are moving ahead and trying to make it better. Kerosene is totally deregulated. LPG with a lag, they do give the under recoveries they give, not 100%, but 80-90%. GLMs are a factor of market demand supply. But petrol, diesel, they've actually allowed companies to make good money to compensate a little bit for the GRMs being lower at times and also LPG losses, which are coming with a lag. But I think overall they are moving ahead. You can't expect them to totally deregulate. But I think the risk return is favorable. So we own HPCL in our portfolio, and we like from a risk return perspective.
You know, Sanjay, I know this is the worst question for as successful a money manager as you are, but I think in larger public interest, we should talk a bit about this. What's happening with this IPO rush? The amount of duds we're seeing on listing day, a number of IPOs which are below listing price or issue price, is a red letter warning to you? Do you think that this is a lesson for investors? Because a lot of investors still flock to IPOs. You should see that in your subscription numbers. Some of the big ones which are available right now, because they're marquee names as well, how are you looking at it?
Yeah, it's a valid concern. One is, we see flows from the mutual fund side is buoyant. FIIs have been consistent sellers, but the supply of papers from promoters, QIP, IPOs are pretty large. So that certainly, and if the overvaluation is high, so we clearly would want to be very, very selective. Where we think there's price value gap, we always compare with the existing listed ownership of holdings that we have. And in certain cases, the larger caps are available at such reasonable valuation. Why would I want to go in a mid and small cap? And we have no compulsion, to buy them. So we have avoided a lot of them. Very, very selectively we have participated. But you're right, the pricing and the valuations have to come off for the new IPOs ahead for sure, looking at some of these listings.
So, what are this? If you can share or just give us some direction on what are the ones where you see that there is value, anything which is buzzing right now. There's WeWork, LG, Tata Capital, the big ones which are on right now, apart of course from the whole array of SME ones.
No, so LG for sure, is an opportunity. We are
Okay.
exploring it. We are also studying it, but it looks to be at a reasonable price. Given the positioning, the dominance, the return ratios. The return ratios are very, very good. And that with growth, the valuations are looking optically rich, but there could be a very clear opportunity. So we are going to study deep and maybe on listing consider at a price to be bought. So on the rest, Tata Capital, I still have to study deeply. I mean, broadly, I tell you, financials, we have a lot of choice. Right, I keep telling internally also from 0.7 times to 2.5 times. Whatever you like, you have the entire basket of stocks. So with that caveat, we'll always compare with existing investing stocks that we are liking and then review that as well.
Okay, so there has to be some kind of opportunity there rather than just look at the IPO for what it is. Fair enough, and maybe that's why LG has this kind of an excitement about it, because it's giving you that access. All right, thank you so much, Sanjay, for speaking with us today. That was Sanjay Parekh of Sohum Assets.